Hello there. Now, many investors have been asking about the possible peaking of US government bond yields. This is important to manage duration risks as investors look to increase asset allocation in fixed income assets, given the prospects of economic deceleration in the US. While this is an important and reasonable question, this should not be the only consideration when investing in fixed income. Now, looking back to history, the long-term bond yields usually rises by less than policy rates. Hence, if there is more policy rate increase to come in the next 6 to 9 months, the US government bond yields should be rising by a smaller amount. The peaking of inflation in coming months could also help to contain the rise in long-term bond yields. Government bond yields also have risen from 1.5% at the start of the year for 10-year government bonds to 3.5% now. This also improves the income return. Moreover, if the US economic activities do indeed moderate in coming quarters, the US Treasury bond yields should be expected to eventually decline in response, implying a rise in bond prices. This will provide some protections against the potential volatilities in the equity market. Then, the next question is whether investors should choose between investment grade or high-yield corporate bonds. The latest economic data are still pointing towards the subdued recession risk in the US, especially taking into account the robust job market. This would point towards a more constructive outlook for high-yield corporate bonds with low default rates and also strong income stream from coupons. The high-yield bond market is also helped by undemanding maturity profile in 2022 and 2023. The current high-yield corporate credit spreads at 550 basis points are above its 10-year average, implying that the bond price is reasonable. Now, investment-grade corporate bonds would arguably be better suited for investors that are more concerned about economic slowdown or even a recession. Now, given a US economic slowdown would prompt US Treasury yields to decline, boosting bond prices, investment-grade bonds would benefit from it too. Since most investors are not going to completely sell down their equity allocation, nor should they, the investment-grade corporate bonds could provide more diversification benefits for the overall portfolio construction than high-yield corporate debt. What does that mean for investors? Now, we can deconstruct corporate bond returns into 3 components: the change in risk-free rates, the change in corporate credit spreads, and coupon yield. In a stable growth environment, high yield is likely to generate a better overall return with potential for some credit spread tightening, contributing to bond price return, adding to attractive bond coupons. Now, this also applies for investors who are less sensitive to mark-to-market volatility and are able to invest through the cycle. However, when economic growth slows down and investors believe that corporate default could be more common, corporate credit spread for all corporate bonds would widen. This negative impact on high-yield bonds to bond price could be more severe than the investment grade. Moreover, the prospects of weaker growth would push risk-free rates lower, and this could offset some of the negative impacts from wider credit spread. Our research shows that investment-grade corporate bonds have a strong advantage here. Finally, investment-grade bonds have a lower correlation with equities. This also gives investment-grade an edge over high yield as a component of portfolio construction when preparing for weaker economic growth in the US.